Our modern financial infrastructure is now facing a massive volume of new stock that it was simply never designed to hold. Private giants like SpaceX, OpenAI, and Anthropic are moving toward public listings, representing the first wave in a massive surge of new corporate stock. These listings could funnel as much as $4 trillion in newly issued stock in just a few months. The active market, made up of managers who choose stocks based on value, cannot provide enough liquidity to buy that much supply. Since traditional buyers lack the capital to absorb this volume, these companies require a systemic mechanism to guarantee that their shares are purchased. A standard IPO relies on pitching a company's merits to investors who have a finite amount of deployable cash. If the investors aren't buying, the listing fails. To bypass the risk of human skepticism, mega-tech companies are seeking a way to tap into guaranteed immediate liquidity without needing to justify their valuations to analysts. Balancing a $4 trillion equation requires moving beyond the active market and finding a buyer that operates entirely on autopilot. That buyer is the passive investment complex. This refers to the trillions of dollars held in retirement accounts and index funds across the country. Passive investors don't choose what they buy. They follow an algorithm that automatically purchases every stock included in a specific index. This automated demand makes index funds the only entities large enough to absorb a $4 trillion supply shock. Securing a spot in a major index provides a company with mandatory demand for its stock, effectively forcing the market to buy. Under traditional rules, many of these incoming tech giants did not qualify for inclusion in major market indices. Rather than companies changing their structure to meet the standards of the index, the gatekeepers adjusted the standards to fit the companies. The Nasdaq wrote new rules for a whole class of companies. SpaceX is just the first in line, with OpenAI and Anthropic following right behind. These institutional changes lowered the entry requirements, ensuring that billions of dollars in passive capital would be funneled into these new listings. The primary goal for these companies has shifted. Success now depends on lobbying index creators for inclusion rather than convincing investors of a company's worth. Securing a spot in the index bypasses the traditional filters of due diligence and price discovery that usually protect investors. The stock market is moving away from a system of active discovery and toward a model of automated capital extraction. The capital used to buy these new shares comes from the biweekly paycheck contributions of workers across the country. This setup is creating a massive volume of forced demand that could lead to a significant IPO bubble in the coming months. The scale of this movement is dictated by the rule changes that allow $4 trillion in stock to be funneled directly into passive accounts. When these companies go public, the buy orders won't come from Wall Street experts making a choice. They will come automatically from the retirement funds of everyday citizens.